All right. Well, we're 4 minutes after. I don't want to take up too much time. I think we've got a good number of people who are checked in. And of course, if you want to go back, as I mentioned, and watch the beginning of this, we can do this. I am going to take my video off of here so you're not looking at my silly face as we're going through some of these slides. So I will stop the video now, but I'll join you back and you'll be able to see me when we do some of the Q&A if we have any questions as we go through. So I want to thank everybody for joining us. We have done one of these in the past. We did it in June. We partnered with JP Morgan. If you were on that before, you'll know that it was a good presentation. We did have some technical difficulties. So in the last month or so, we've worked pretty hard at resolving those. And I think you'll have a little bit of a better experience here. We're going to try and keep doing more and more of these web presentations for everybody. You might know that we get together from time to time, well, actually usually about twice a year over at Fort Washington Country Club to cover a topic that might interest people, whether it's relating to Medicare, Social Security, the markets, so on and so forth. And so because we can't get together in person, we're doing it digitally or virtually, if you will. So that's what this is about. And when we're halfway through the year, naturally, we want to try and tackle a mid-year outlook, and that is something that LPL Research puts together. And we partner with LPL. If you've been with us for some time, you're familiar with LPL most likely. And we, in addition to several other research items that we use and research that we do on our own, we also use LPL's research. And so I think it's relevant if we take a look at the LPL Research mid-year outlook to see what may be coming down the road in the next 5 to 6 months. And so we're excited to present LPL Research's mid-year outlook 2020 using their and our updated pillars of investing. So we're taking a look at the economy, we're taking a look at bonds, and we're taking a look at stocks. And as the headlines change daily, we look at these pillars, or trail markers, if you will, because we're talking about the trail to recovery. And we use this mid-year outlook to provide some perspective on how we might face the challenges that we're dealing with now, and how we might prepare to move forward together. So at the midpoint or just past the midpoint of 2020, we're mindful it's been a challenging year so far here in the US and around the globe. We're in the midst of a pandemic that continues to impact all of us. It impacts our communities, our economies, and together we're looking for new ways to face these challenges and how we can prepare for better times. I think these webinars are one of the ways that we face these challenges. I see a Q&A hand raised. I don't see it now here. Okay. So I have one question, most important question: when to get the heck out of the market, or how to temper the cliff fall ahead? Okay, well, we'll tackle some of that. I don't know if we're necessarily facing a cliff, but we'll definitely get to that. I think, we are wanting to look ahead to see what's going on. And we've been impressed by what we've seen so far. We've seen resiliency and accelerated innovation among large and small U.S. businesses. We've seen efforts by our national, state, and local governments to support our communities. I know there's some unhappiness with what's going on right now with Congress in terms of, we're watching the sausage get made right now with some potential additional stimulus, but we've gotten some so far and it's been tremendously helpful. And I think most of all, the dedication and unprecedented cooperation among our frontline health professionals, medical researchers, and everyday people who have helped get all of us through this health crisis. It's important to recognize that. But let's start with, as I get through here, we're going to start with the economy. This is one of our first pillars. And, we're going to, as I mentioned, we're going to take a closer look at the economy, the stock market, the bond market together. And then at the end, we're going to take a look at election 2020 and talk about whether or not stocks can predict who might be the next president. But we're going to start here with the economy. And much of the real-time economic data that we follow, such as transportation activity, home sales, jobless claims, is showing tangible evidence that the economic activity has begun to make a comeback, though I'll recognize it's still at depressed levels. And we're even seeing a little bit of a slide here just very recently. We are seeing certain corners of the market start to come back. So let's keep moving here. So the second core, the economy entered a recession in March 2020. And this was a result, as it doesn't take an economist to know, a result of the lockdowns and business closures that we engaged in to try and contain the coronavirus pandemic. The recession was declared by the National Bureau of Economic Research, who decides whether or not the U.S. is in a recession economically. And we saw already that GDP contracted by 5% during the first quarter of 2020. And that's measured on an annualized basis. And you can see here in the slide that Bloomberg takes a consensus of expectations among economists. And you can see here that the consensus expectations for the second quarter are calling for a mind-blowing, nearly 35% annualized contraction, as you can see right here. So this is the wild number. If you're talking to your advisor, if you've talked to me at all, how we've been talking about recession and contraction and some of these crazy numbers like unemployment. You can see it here. I think there's a pretty wide consensus among economists that we're seeing that we have experienced a pretty big slowdown. But I think here at Ford Financial Group and along with LPL Research, I think we see the potential for a strong second half rebound of economic growth as more and more of the economy opens up. If this does come to pass in this way where we are able to open up the economy, this could result in being one of the shortest recessions we've ever had. But even with strong recoveries, and you can see here in the projections, 20% in the third quarter and perhaps almost 8% in the fourth quarter, it's unlikely that this is going to be enough to bring us back to where we were at the end of 2019. And as we kind of move forward, you can kind of see here that the trajectory of the economic rebound remains uncertain. And it's based on the depth of the contraction and a multi-stage recovery that LPL calls for a contraction now, but not getting back to 2019. Second half growth headwinds could very well linger into 2021 and really suggest a kind of a swoosh shaped recovery, or if you prefer, kind of a check mark where we've got a quick, sharp decline, and after a small snapback like we've had, a gradual recovery over the next 12 to 18 months. We've heard about lots of shapes. We did a podcast about the kind of shapes that recovery may take. I've heard that the square root symbol might be one of those. I think that square root symbol is too pessimistic because it really implies kind of a flat phase of recovery after the initial bounce. We've also heard analysts suggest that recovery might take a U shape, but I don't think a U shape is really applies here, because what we're likely to see, I think, as we follow this swoosh, this Nike swoosh shape, is that we're going to have multiple stages of recovery where certain sectors of the economy aren't going to all recover at the same time. So if you're interested in hearing the alphabet soup of recovery shapes, you can email your advisor. We can send you the link to the podcast. But I think keep in mind also here, as we look at LPL's base case, and you can see they're kind of in the middle, they're expecting a GDP contraction of 3 to 5%. This swoosh characterization assumes that a coronavirus vaccine won't be widely available for another year or so. So if we get progress or an early arrival for some vaccine, that could actually help sustain the momentum that we've had from this initial rebound and move the economy closer into a V-shaped recovery. So that's kind of our economic discussion. We're going to move. Let me take the break right here and see if we have any questions. I don't see any questions. Let me check the chat. Okay, so no questions. What I think we'll do here is we'll move now on to the stock market. And I think this is when we're checking in for a mid-year outlook, this is what a lot of people want to know. And we've already seen stocks pricing in a pretty steady economic recovery beyond 2020. There's a lot of question about how the market could bounce back so much in the second quarter. And it's really because markets are looking forward into the second half of the year and even maybe into early 2021. And so I think where the stock market is right now could be supported if we do receive some sort of breakthrough treatment to the coronavirus. But I think the optimism right now we see reflected in the S&P 500 might actually limit the size of the gains that we have over the balance of the year. So let me move to the next slide here. This takes a look at bear market recoveries over time. And so I think LPL's expectations for a gradual economic recovery in the second half of 2020 seem to kind of be in conflict with the S&P 500's rise over the second quarter from March through June. On one hand, the gains appear appropriate based on the likelihood that a recession may be the shortest ever if we get stimulus and progress towards a vaccine. But I think on the other hand, a risk of a second wave of coronavirus still exists. We're seeing firsthand a rise of infections and hospitalizations here in California. We're seeing it through other southern and western states. And I think on top of that, it's going to take some time to recover the 20 million jobs that were lost in March and April. And it takes a while for those jobs to come back when we're still dealing with social distancing constraints and kind of persistent and lasting changes in consumer behavior. The uncertainty, I think, here is that we may have come too far, almost too fast. Although some recessions see quick recovery after losses, and you can see that here if you're looking in November 1980, we took 3 months to recover. In July 1990, it took 4 months to recover. But most of the time, the journey back to record highs have taken a year or more. And just for some context, you can see here in the recession that we associate with the 2008 Great Recession, it took 49 months, or about 4 years, to recover and get back to where things were before. And so I think we need to take, while we're certainly happy that we bounced back in that second quarter, I think we need to be realistic about how much time it might take to really kind of bounce back and see that economic bounce back reflected in markets. We can also see, we're going to get a little bit deep in the weeds here for a second, but we wanted also to take a look at the earnings per share declines that we get during recessions. So in this slide, we're looking at earnings per share for the S&P 500. Earnings per share is calculated as a company's profit divided by the outstanding shares of its common stock. So it really indicates how much money a company makes for each share of its stock, and it's widely used as a metric for corporate profits. And so right now, LPL Research is forecasting an earnings per share number for the S&P 500 somewhere between $120 and $125 per share. So that means at midpoint, earnings would drop about 25% from the 2019 level of $163 a share. You can see here that estimate is roughly in line for the historical average of the decline in recessions. That's what you see here on the right side of the chart. So I think this LPL here is trying to forecast three things: the severity of the decline in economic activity in March and early April. The initial snapback in activity is reflected in here that we saw as states began to reopen in the beginning and middle of April. And then also this recognizes that there are going to be some growth headwinds that are going to constrain the trajectory of the recovery as we get into later this year. So that's kind of earnings per share. It matters as we get into multiples here. You're going to see kind of here, this is where we start to I think, answer that initial question that we got here. I see an open question here. Maybe a stupid question, but what's keeping us from a 1929? Okay, so that's from Doreen. I'm going to answer that in just a second, but I want to continue with this slide here that we're looking at. I think I mentioned this before, but LPL Research believes, and I kind of tend to agree here, that the optimistic economic recovery scenario that we are seeing reflected in stocks right now could kind of limit the upside potential as we get into the second half of the year. LPL's year-end target range for the S&P 500 is 3,250 to 3,300 based on a PE ratio, a price to earnings ratio slightly below 20, and a normalized earnings figure of 165. Okay, that's a lot of jargon. What does that mean? The market trades the S&P trades at a multiple of earnings. So what we're doing is we're kind of trying to project what earnings might be or what they should be, and then it'll trade at a multiple. And so LPL is figuring that a fair value for the S&P 500 right now is somewhere between 3,250 and 3,300. A little bit earlier today, I haven't looked right now, but a little bit earlier today, the S&P was trading at 3,240. Right? So that gives us an idea that we're probably pretty close to fair value. And I would even argue that a multiple of 20 and a normalized earnings figure of 165 might even be a bit optimistic. And you can see some differentiation here. LPL uses a base case, so what they think is most likely to happen. In a bull case, so there's some good developments, we could go north of 3,450. If things go bad, we could go south of 2,650. So there's some divergence in there. I think LPL in this case is comfortable using some longer term earnings forecast to create this target value because interest rates are so low, and that can help spur some growth. And so that's why that kind of optimistic expectation is baked into the base case. Before we move on from equities, the question here that was posted was, what's keeping us from a 1929? I always hesitate to try and say this is different this time or things are different this time, because very rarely are we smarter or less greedy as human beings than we have been in the past. I think in this case, though, we really do have some protections in place that didn't exist back in 1929. The Federal Reserve, central banking, those kinds of things make a huge difference. We've even seen a difference in this case with the market dip in the first quarter. That was different from even 2008. In 2008, we were dealing with a financial crisis, a run on banks. The source of the problem was in the financials. Here, we're dealing with a public health crisis that is created a recession that then has been reflected in the stocks. And so the solution or the issue that needed to be addressed was addressing the financial crisis in 2008. And it was done with the Federal Reserve lowering rates and providing stimulus and even doing some bailouts. That level of stimulus that we got in 2008 was nothing compared to what we've just done here in 2020. We have a stimulus to the magnitude 3 times as much stimulus almost done in less than half the time here with what the Federal Reserve has done by buying bonds, buying distressed securities. We had congressional stimulus rolling out very quickly. So there is, and even some more on the way potentially. So I think there is a lot, to answer the question in summary, really, I think there are a lot of things going on here to keep whatever is going on from becoming another Great Depression, which is really what I think the question was about. So let's move on to bonds and the bond market. So I know a lot of the questions that we get like to focus on what's going on with stocks, but bonds make up an important part of a diversified portfolio. And for many of you, bonds actually make up a larger part of the portfolio than just your stock allocations. If you are drawing money from your portfolio, or you just tend to be a more conservative investor generally, you have a healthy chunk of bonds most likely as part of your investments. And bonds really are affected in large part by interest rates. And I would think if we just cut to the chase here, LPL really expects interest rates to remain at historically low levels. There's a possibility here, though, that rates could move higher through the balance of 2020, but still remain relatively low. In fact, LPL's year-end base case forecast for the 10-year U.S. Treasury yield is somewhere between 1 and 1.5%, which would be the lowest level to end a year on record if that actually comes to pass. So we're talking about very, very low rates. In fact, bargain basement rates, which kind of gets us to bond income. I don't know if anybody's taken a look at CD rates lately, but they're god awful. And rising Treasury yields contribute to bond prices falling. And so I think some of the concerns with LPL Research's concern that rates may rise over the balance of the year is that rising Treasury yields can contribute actually to bond prices falling. So I think there's this mistaken belief that bonds can't go down, and they are an investment. They are not as risky as stocks perhaps, but they can go down. Now, even if bond prices fall a little bit, it can be offset by credit spreads tightening and the interest income that bonds provide. So you don't necessarily have a negative return, but you can kind of see here in this chart that with the credit spread for the Bloomberg Barclays Aggregate Bond Index, which is the kind of broad bond index, it's already near the average for the last cycle, and interest income's at historically low levels. I think LPL expects the index's return to be near flat, really, over the rest of 2020. And in fact, if rates do rise, there could even be a small risk of loss over the next 5 months as we finish out the year. But I really think it would take a move well above the target range of interest rates to actually erase bond gains from the first half of the year. If you've talked to your advisor and looked at some of your investment grade corporate bonds, which are usually a big chunk of that conservative side of your portfolio, have actually done really well through the first 7 months of the year. So, but with interest rates being so important with bonds, we take a look here and we try and look forward here, right? This is an outlook. and see where we think interest rates might go as we move forward. And you'll see here, I think the economists have been surveyed by Bloomberg, and I think these economists probably agree with LPL Research, and I tend to agree myself that it's pretty unlikely that the Federal Reserve is going to hike rates in 2020. Even if the economic recovery is a little bit better than baseline expectations, I don't think they're going to raise rates this year. And there's a very real possibility they won't do anything in 2021 either. You can see here that of the economists surveyed by Bloomberg, relatively small percentage actually believe we're going to see a rate hike by the Federal Reserve before 2022. And in fact, even less than half of the economists surveyed think that the Fed's going to raise rates by the end of December 2022. So I think really what's going on here is that persistently low inflation during the last expansion from the 2008 recession is helping to minimize any Fed concerns that it needs to raise rates to preemptively keep inflation under control. That's what I think is really at play here. So I'd expect, consistent with their messaging, I'd expect the Fed to remain accommodative for some time, and raising rates probably won't be on the table until after the Fed ends its bond purchase program, which is known as quantitative easing. So just for some context here, the Fed didn't start raising rates in the last economic cycle until more than a year after its final round of bond purchases. And we're nowhere close to being done with that. So I think LPL, the advisors at Ford Financial Group, and most of the economists that are surveyed by Bloomberg think that the Federal Reserve probably won't be raising rates for quite some time. So I'm going to check back in here and see if we have any other questions. I'll check the chat here as well. It looks like we don't have any questions at this point. So you can see, I think realistically, if we're talking just kind of go back on these three pillars, economically, we are still facing a recession that we're coming out of in the second half of the year, but we may not be out of entirely before the end of 2020. As we look at stocks, they've kind of raced ahead. Certainly investors expecting that the rebound in the second quarter came on expectations of the economy reopening and some progress on therapeutics or vaccinations for coronavirus. And so we might be a little bit ahead of ourselves there. And I think bonds, though they've done well, there may not be a whole ton of room for improvement as we get into the back half of this year. But anything's possible here, of course, and predicting the future is a tricky business, I will say. And part of what we have to look at here is the election. And so we'll kind of move forward here. This is something that we're going to try and dig deeper into during our next webinar. So still stay tuned for that. But I think we can't give a mid-year outlook during an election year without at least touching on this topic. All election years are different, but this one feels particularly chaotic. We have a pandemic, a recession, heightened partisanship, a mail-in ballot controversy, an unpredictable president, and the oldest presidential candidate ever. There's a lot going on here. I have a question here about what will happen with a Biden presidency if we have one. Suzanne, I will get to you to that question here in a moment. In fact, what I'd like to do, we talk about what's going to happen based on who is president, but I think here as we get into the kind of the election, the question that we get most often is whether stocks are going to perform better under a Republican or a Democratic president. But I actually think that's the wrong question to ask. Well, I'll answer it, but I think it's the wrong question, because for legislation to get passed, it needs to work its way through Congress first. So I think that's where we need to look first. And what you're going to see in this slide is that stocks have actually tended to do their best when we have split Congress. Markets tend to like checks and balances to make sure one party doesn't have too much sway. So you can see here, if you're looking on the left side of the slide, when Republicans have controlled both chambers in Washington, D.C., on average, the S&P 500 has gained almost 13.5% per year, and GDP has grown about 3%. If you look in the middle there, you'll see that when Democrats have controlled both the House of Representatives and the Senate, the economy did a little bit better with GDP growth of 3.3%, while the S&P 500 was up a little bit less by comparison, just short of 11% on average. But if you look to the right, when we've had split Congress, the average S&P gain climbed to a little bit more than 17%, while GDP growth averaged about 2.8. This again kind of suggests that markets and investors might prefer split power come November. So, Suzanne, this is where I will get to your question here. Will a Biden presidency send the economy and the markets downward? I can't tell you specifically. Based on polling, it seems that my guess is that markets may have already baked in a Biden presidency to what's going on here, but it hasn't actually moved markets. And the reason I think for that is because investors at this point still believe that Republicans will retain control of the Senate, which gets us back to split Congress, right? When you have Republicans controlling both houses of Congress and the presidency, or Democrats controlling both houses of Congress and the presidency, you tend to get big sweeping change either to the left or to the right. And we've seen this happen over the last several presidents, where we had tax cuts when Republicans were in control just recently. We had Obamacare when Democrats were in control, 10 years ago. We had the Bush tax cuts happen early on in Bush's presidency. And even Clinton had a couple of years before 1994 that the Democrats controlled Congress there. So what we've seen in the past is that when you have one party controlling everything, you tend to get big sweeping change. And then in very short order, voters will come in and kind of turn the tables on that and take us back to kind of divided government. And that's tended to do really businesses, investors can more easily digest change when policy changes are coming more slowly, and there are fewer unintended consequences that you get with big sweeping change that can be to the left or the right. So to answer your question, Suzanne, I don't know that specifically a Biden presidency will send the economy and markets downward. I could see that it could create some turbulence in that investors might have to change their bets. If the expectation is that Trump will become president and then Biden becomes president, well, if you're invested in coal, you might want to exit that investment and get into renewable energy or something. I'm just using that as an example, not as a recommendation, but you're going to have policy tending in one direction, and you need to account for that as you're investing. So I hope that answers your question. Let's move to the next slide here, which is an interesting one because if we're looking at an outlook and we're talking about elections, I guess we need to talk about an outlook on the election ahead. And what's interesting is that the stock market performance for the 3 months ahead of the election has delivered a pretty solid track record of deciding who will be in the White House next January. So the S&P 500 is interesting. It's predicted every presidential election winner since 1984, and it's predicted 87% of the winners since 1928. So as you might expect here, the incumbent party is favored if stocks are higher in the 3-month period before the election. And as you can see here in this chart, if stocks sell off ahead of the election, the opposition party has tended to win and the incumbent party has lost. This includes, we're talking about incumbent parties and challenging parties or opposition parties because if we have somebody not running for re-election, this still actually carries weight. So we've actually covered this phenomenon in an earlier podcast as well. And so you can feel free to email us if you'd like a link to that episode as we get into that. But I don't know if as we walk through this, it's an interesting stat to see. But if you kind of digest it and think about it, it makes a little bit of sense. People tend to vote their pocketbooks. And if the market's going down, people probably feel as though they have less wealth and that we're not on the right trajectory, and then they might be voting for change, where if the stock market is on its way up, people are feeling better about things, and with that optimism, they vote for the status quo. So it'll be interesting to see how things go in the next few months with the S&P 500. Not a perfect predictor, but a pretty reliable one. So I'm going to take a quick pass through here and see if we have any other questions. I don't see any in the question box. I don't see any in the chat either. So if you have more questions, I'd be happy to answer them for you. We've covered stocks. We've covered bonds. We've covered the economy. We've covered elections. I think in reality, this last slide it kind of exemplifies if we thought we knew what was coming in 2020, we've been humbled to say the very least after what's gone on. And if you are playing coronavirus bingo and you had UFOs as the thing that came next, you win. I don't know that UFOs are going to land anytime soon, but I think it goes to show that this volatile nature of the times right now it really has everybody on their heels. And I think this makes it more important than ever that we stick to our investment plan. We stick to our retirement plans, and we keep a level head as we navigate through all of this. 2008, I think, taught everybody, or reminded at least everybody, that if you stuck to your guns, when things go down, they do recover. And then we got that same lesson over the course of only 6 months here earlier in the year. So, it's an important lesson to be reminded of, as we were just recently. The last couple slides here are really just disclosures, important disclosures, talking about general risk and kind of the indices that I discussed a little bit earlier. I'll summarize this by reminding everybody that I can't predict the future. I don't have a magic 8-ball or a crystal ball, but I think you know that already. So with that, I will kind of open this back up to Q&A. If you have questions, you can type your questions into, I'll start my video here. You can type your questions into the Q&A section, or if you prefer, you can also type it into the chat, and I'll be happy to answer the questions for you that we kind of, if you have any questions relating to what we talked about today, or if you have other questions, I'd be happy to answer those for you as well. We've been going for about a half hour. So I feel like I hope I haven't been rambling on too much. And I think, our goal here is to have this be as clear as possible for you. As much as we want to avoid it, we don't want to talk in jargon or over anybody's head, because then what's the point of having a webinar to explain things to you? So I think if we're going to summarize here, we're talking about, we're in a recession. The speed with which we'll come out of a recession is still open-ended. The numbers in June were positive as we were getting economic numbers in June. But July's not over, but we're getting some numbers here in July that are suggesting that things are slowing down again, which could lead to some turbulence here as we finish out 2020. And then you add in turbulence that could come from the election or a host of other factors. I mean, goodness, we started 2020 worrying about World War III with Iran, and look how long it's been. It feels like with this coronavirus that 1 month equals 1 year almost. And so as slow moving as it's been, we want to keep in mind that we want to kind of stick with things here. Okay, I'm getting some things rolling in. Ron Thomas has reminded me, go Dodgers, which is something I really disagree with. But the Dodgers have a good team and the Giants don't this year. So Ron, I'll give it to you for this shortened season. Steve Jolly's on here, one of the advisors here with us. And he reminds me to remind you, and thank you, Steve, that if you want a copy of these slides or some more information, you can email your advisor and they will forward this on to you. Or if you want a recorded copy of this, if you're interested in that, or if you missed the beginning, we'll work on getting that out to you as well. I would suggest you just go straight to your advisor if you're looking some more for the slides or some more information on this. But if you don't have an advisor with us and you happen to be on this webcast, anyway, you can also email the firm at info@fordfg.com and we can make sure that we connect with you that way. So I see another question coming in. Long-term investments are obvious, but short-term investing still unwise with regards to, for example, home office type companies. I can't really get into specific names in this format. I can't get into specific names of short-term investments or companies that you may want to have a short-term investment with. Simon, I would suggest that you get with your advisor directly to see where this might fit specifically in your portfolio and in your outlook, both long and short term. There are definitely some change going on right now. Home office type companies are certainly, well, look at the background here. You can see at least one of us on this webcast is coming to you from their home office. Things are definitely changing. I would say that coronavirus has led to an acceleration of change in technology. That's why you see some of these large cap tech names really accelerate ahead, because they're poised to take advantage of this. But I would be hesitant to just presume that life is going to be altogether different from here on out. I think if sheltering in place or social distancing has at least taught me anything, it's how desperately we all need to go out and see each other and be social in person and around each other. So while there is definitely both societal and economic and even market changes that are coming from this, I hesitate to go the full step by saying it's all different now, because it's almost the moment you say that, things can revert to being the same. So I'll check one more time. Nick, I saw you raise your hand, but I don't see a question on here. Suzanne, I think we got your question. So I guess we'll leave it there. If there are no more questions in the Q&A and in the chat, I thank everybody for joining with us. I hope that this has been really easy to follow along with. I hope we've been able to iron out all the technical glitches that we had in the last one of these. Stay tuned. We're working right now on putting together something more specific towards the election that I think will probably generate a little bit of interest, as we're now, I think, 98 days away from the election. So we'll work on that and get back with you. If you're interested in connecting with us in other ways, I'd encourage you to follow us on Facebook. We post updates regularly on there. In fact, we post a lot of our blog updates onto Facebook. We have Facebook, LinkedIn, Twitter, and we actually have a YouTube page where we post many of our videos that we do, our update videos. So we want to make sure that we are accessible in a way that you are comfortable finding and getting information from us. And so, and then, as I mentioned, you can always email your advisor or email us at info@FordFG. So with that, I will stop the webinar here. I appreciate everybody for joining on, and I look forward to talking to you in the next one. Take care.